Good morning. This is Dan Russo, Chief Market Strategist at Chaikin Analytics, bringing you Chaikin PowerFeed, your daily market digest. Today is Monday, May 7th, 2018. I hope that everybody had a great weekend. PowerFeed TV is brought to you, as I said, by Chaikin Analytics. You can get your daily Chaikin PowerFeed at www.chaikinanalytics.com/PowerFeed TV. You can follow me on Twitter. I am at Dan Russo _CMT on Twitter. So just a quick recap of the markets last week. The major U.S. equity indexes finished mixed, but that was with the help of a big rally on Friday. Technology was a meaningful outperformer. Telecom and healthcare fared the worst, though consumer staples, industrials, and financials were all down by more than 1%. Financials kind of getting hit as rates backed off from the 3% level, and the curve saw some flattening. As I said, treasuries were narrowly mixed with some curve flattening. The dollar index gained more than 1%. Gold lost 70 basis points, and oil just on fire was up nearly 2.5%. On Friday, we did receive the non-farm payrolls number, and there was an increase of 164,000 jobs in April. That was below consensus expectations of about 190,000 jobs being added, and that did follow a disappointing, though upwardly revised, 133,000 job increase in March. So let's kind of look at the key levels as we always do. For the S&P 500 last week, two tests of the 200-day moving average. One a slight probe through before reversing to close higher on Thursday, and then a quick test on Friday before closing near the top of the range. So key support remains at that 200-day moving average. That is 2616 on the S&P. Below that, 2581, which is the February 8th close, as well as a series of opens and closes, and then 2545 and 2533, the extreme lows from this consolidation that we've seen since the market made a high in January. Resistance remains in this zone between 2658 and 2675. You can see we returned back from that level 3 times last week. Above that, 2710 and then 2741. So the message that I've been hammering home to readers of my daily morning note is that the S&P 500 remains in a consolidation within the context of a secular uptrend. These key levels that we have been highlighting remain in place both on the upside and the downside. So bulls want to see the index trade above 1710 and ideally 2741 in order to have some confidence that the market will exit this consolidation to the upside and continue the secular uptrend. If bears, they want to see a sustained close below this 200-day moving average and ultimately an undercut of the February lows to give them conviction that the secular uptrend is in fact reversing. So now your market in a minute. As we said, the S&P 500 successfully tested the 200-day moving average again last week. 10-year yield pulled back from the 3% level. That hurt the financials. Commodities are beginning to break out, and that's being led by crude oil. The dollar continues to advance, and that's kind of interesting here that the dollar is advancing and commodities are breaking out. That's a relationship that's normally inverse. So we'll take a look at that, and the futures are pointing to a higher open today. Your market in a minute, just taking a quick look at the major indices via the Chaikin Power Bars. According to the Chaikin Power Bars, small cap stocks remain somewhat more bullish than large cap stocks, and major indexes are mixed indexes, trading consolidation, that all lines up. The Dow, the power bars, which tell us the number of stocks which are very bullish and bullish, neutral, very bearish and bearish. The Dow is skewed to the bullish side slightly, 8 to 6. The S&P saw some deterioration last week, 72 bullish or very bullish stocks for 97 bearish or very bearish stocks. NASDAQ somewhat more balanced. Small caps, big theme for us is small cap outperformance, and we can see it here in the power bars. The small caps are skewed more bullishly than bearish. Bonds saw an uptick on Friday. Yields came down, and as we said, technology up 1.9% on Friday, skewed to the bullish side for the power bars, seeing some real outperformance in the technology sector of late. Every day, Chaikin PowerFeed subscribers will receive a stock of the day. The stock of the day for today is Saber Corp. They come to us from the Computer Software and Services Index. Went out at 23.27 on Friday, down 17 basis points. We can say here there is a very bullish Chaikin Power Gauge rating, and that is a function of strong earnings performance, very strong price and volume activity. That's the technical component that we look at. And on the sentiment side, we see some positive expert activity. Let's take a look at the chart here. As we can see, again, very bullish power gauge rating. Trend is strong within a strong industry. That's what we like to see. And then from there, we read the chart from the bottom up. The ribbon at the bottom tells us where the power bar is currently and where it has been over the past year. And we can see just an improvement, right? We were bearish or very bearish about a year ago, up until about December when the model turned neutral, turned bullish briefly with this uptick in March, and then we backed off and we're neutral again. And now we are very bullish. Relative to the SPY, we are starting to see a personality change again, with the stock beginning to outperform the SPY. And that's what we want to see. We want to see relative outperformance versus the market in line with a bullish or very bullish power gauge rating. That's a powerful combination. We look for that in stocks that we think could outperform over the next 3 to 6 months. But from a tactical perspective, we want to make sure that we enter and exit trades properly from a timing point. And we can see here the stock is overbought based on our overbought, oversold oscillator. We'd rather enter a trade, when the stock is closer to oversold, as we could see down here with the stock just below $20 before it ripped to 23. Additionally, while we are seeing some improvement recently in money flow, the money flow is bearish, so we want to monitor that. We'd rather bias the stock with some bullish money flow that gives us an indication that institutions are in fact buying the stock. So we can see the gap up here on earnings, and now we're starting to backtrack a little bit. The stock is above a long-term trend line, which is beginning to move higher. So ticker SABR, one to have on your bullish watch list, although from a timing perspective, as I said, the stock is overbought and money flow is still negative. Let's keep that on a bullish watch list. I know I'm going to do that and keep, look for a better entry point, maybe closer to this $21, $22 level here on the gap. Going now to our sector tractor, let's see how the major sectors have been performing over the past 5 days. As we said, technology has been strong. That was really a function of the move, 1.9% on Friday. Real estate, as the market's been shopping around, I think real estate is seeing a little bit of a defensive bid. They tend to outperform in markets that are declining. Materials and energy flat over the past 5 days. I wouldn't be surprised to see energy start to pick up here though as oil trades higher. Healthcare, worst performing sector in the bunch over the past 5 days, and we've seen stocks like Medtronic get hit hard. That was down nearly 4% on Friday. Nectar, NKTR, that's been a momentum leader. That stock was down close to 7% on Friday. Becton Dickinson got hit for over 1% on Friday. So that's really dragging on the healthcare sector. Our industry focus is technology services, which over the past 6 months, the NYSE technology services subsector has outperformed the S&P 500 by 4%. Its power bar ratio, which as we said is a measure of future potential, is very strong with more bullish than bearish stocks. And the industry group is currently ranked number 6 of 21 subsectors, and it's moved up 6 slots over the past week. So here is a bullish industry in a bullish sector. This is a group where we want to go hunting for long ideas. And some of the indicative stocks in this industry are Baidu, VMware, and Cognizant. We'll point out that Cognizant is reporting earnings this morning, so let's see how they do. We mentioned the Chaikin Power Bar. We have 10 very bullish or bullish stocks, 22 neutral stocks, and only 3 bearish or very bearish stocks. So we could see the setup here for future performance skewed to the bullish side. Let's look at one of the indicative stocks in this group now, turning to the chart of VMware, ticker VMW, closed on Friday at $134.35, up 1.11%. Upper left-hand corner is the power gauge rating, very bullish, as we said. We know that the trend is strong, and we know that the industry is strong. So let's move to the bottom of the chart and read here from the bottom up. Here's the ribbon again, pointing out that the power bar is, in fact, very bullish. And here is that, that duo. We can see that the stock is outperforming relative to the SPY. So the market is in agreement with the model, as we like to say. So when the stock is leading the market and the power gauge is bullish or very bullish, that's an indication that the model and the market are in agreement. So now we have a name here that looks compelling on the long side. Let's look at the tactical setup. The overbought, oversold oscillator is closer to oversold, on the verge of going below that 30 level. So that is constructive from a tactical standpoint. Money flow has been bearish of late, although much less intensity last week than we saw in the previous week. So we'll watch for money flow to go positive to give us an indication that institutions are, in fact, accumulating the stock. Looking at price action, stock is trading above a rising long-term trend line, and above price-based support in the 125 to 130 level. So VMware, certainly a name that's worth consideration for a trade on the long side. I'll certainly be adding it to my bullish potential ideas list, keeping an eye on this stock, which is in a strong group within a strong sector. Software really has held up well throughout the consolidation in the market here. So looking at some earnings surprises from Friday, VF Corp beats by 2 cents. Celgene misses by 17 cents. That's a big name in the healthcare group. Another reason that sector has been outperforming. IDEX, a neutral rated stock, IDXX beats by 8 cents, and Aon PLC in the insurance space beats by 18 cents. The insurance space is certainly a sector, a group of the financials that has been lagging, and for financials to continue to work, we'd like to see insurance start to join the party. Reporting today, I think it was really over the weekend, Berkshire B, the Berkshire Hathaway annual shareholder meeting was this week, so their earnings print was out in front of that, actually reporting a loss for the first time in a while due to some accounting changes. But the Berkshire annual meeting is always well attended, and some of the news and stories that come out of that are always worth interesting. I know I'll be spending some time today catching up on that. So something that I've been talking a lot about has been the outperformance of small cap stocks relative to large cap stocks. It's a theme that I've been harping on, and I think that there are two main drivers here. Number one, trade tensions are still in play. And, you know, we've kind of moved them to the back burner a little bit as we've ground through earnings season. But as earnings season winds down, attention is going to turn to the macro, and trade concerns are still there. As long as trade concerns are an issue, I think small cap stocks can outperform relative to large cap stocks, because obviously they receive more of their revenue here in the U.S. than they do from overseas. So I think they're somewhat more immune than their larger cap brethren to what is going on the trade front. And the other dynamic within the market, this is why intermarket analysis is so important, is the strengthening dollar. As the dollar strengthens, revenues and earnings earned overseas are translated back into dollars at a lower rate, and that impacts the financial statements of large multinationals. And again, because the small cap stocks tend to get more of their revenue and more of their earnings here in the United States, they are set up to outperform their large cap cousins when the dollar is rising. And as we said, the dollar index has broken out of a consolidation, now trades over the 50-day moving average, which is rounded up, and over the 200-day moving average. So keep an eye on the dollar and keep up to speed on what's going on the trade front for an indication of how small cap stocks could outperform relative to large. But here is the chart. We can see it's a solid uptrend for the Russell 2000, consolidating here, but remains above the rising 50-day moving average as well as the rising 200-day moving average. And momentum is starting to shift to bullish ranges. And, you know, this is something we'll monitor. We'll want to see the RSI, my preferred momentum indicator, confirm a breakout with a move higher, but we can see that there has been a series of higher lows lately for the RSI. So we want to watch for a breakout for the Russell 2000 confirmed by momentum to give us an indication that this uptrend will remain intact. So that's kind of the recap for the day and setting you up for Monday morning. You can subscribe to PowerFeed at www.chaikinanalytics.com/PowerTV to get powerful and profitable stock ideas delivered to your inbox every day. You'll receive the market in a minute, the power bars for the major indices. Certainly worth a look. www.chaikinanalytics.com/PowerFeed TV. Have a great Monday, everyone.